Welcome to the deep dive. Today we're getting into something pretty significant. We're looking at that intersection between the big players in traditional finance and the whole world of digital assets. Specifically, we're going to unpack some really important recent talks between JPMorgan Chase, America's biggest bank, right, and the SEC's own crypto task force. Our goal here for you is pretty simple. Pull out the key insights, understand the context, and figure out what it signals for, the future of capital markets.
Yeah, and it's fascinating because it feels like the conversation's really shifted, doesn't it? For a bit, it seemed like Wall Street was just kind of watching crypto from afar.
Totally. Just observing.
But now, well, it's not just that JPM is involved, it's how.
Exactly. That's the key part I wanted to touch on. It seems like they're working within the existing rules of financial frameworks we already have. Not like trying to build something totally separate from scratch.
Yeah.
So what does it mean when a giant like JPM gets serious about using public blockchains for capital markets? What are the real changes, the opportunities?
Well, that's where it gets really interesting. This isn't just theoretical talk. The discussions we know about, they zeroed in on the on-chain migration of existing market activity.
On-chain migration, okay.
Right. So think actual business models. Where can they find a competitive edge? It's not just let's put stuff on a blockchain. It's more fundamental. It's about rethinking how capital markets actually work. JPM seems to be asking, how can we take these huge regulated multi-trillion-dollar flows and make them faster, 2047, less friction, but on-chain? And actually, speaking of JPM, there's a quite surprising little twist regarding their own digital asset stuff that ties right into this.
Okay, let's picture the room then. The SEC note mentions 3 JPM execs met the crypto group. Scott Lucas, Justin Cohen, Aaron Iovine. Their titles, markets, digital assets, equity derivatives, regulatory policy. That says a lot, right, about how serious they are?
It absolutely does. You've got markets, tech development, and regulation all represented.
And they talked about moving existing capital markets to public blockchains, how the model changes, risks, benefits. That's a heavy discussion.
It is. And if you connect the dots, it shows JPM isn't just testing the waters. They're looking at their current crypto footprint, like their repo platform, their digital financing services.
But they already have things running.
Exactly. And they're figuring out how that fits, where they can get a real market advantage. Faster settlements, cheaper transactions, maybe new revenue from tokenized assets. But, and this is key, within their regulatory comfort zone, it makes you ask, what does it signal when a bank this big sees an edge, but in this specific, measured way?
And it wasn't just talk, was it? Because right after JPMorgan announced something concrete, a pilot for a deposit token called JPMD, and they put it on Coinbase's blockchain.
Yep. Action followed the talk.
Plus that trademark application for a bunch of crypto services. It showed real intent, a clear direction.
Precisely. Now, that deposit token pilot, JPMD, it got people thinking, oh, are they launching a stablecoin? But then Naveen Mallela, he's an exec at Coinex's, JPM's blockchain unit, came out and said, no. He explicitly called deposit tokens a superior alternative to stablecoins for institutions.
Superior alternative. Why?
His point was scalability linked to their fractional reserve backing.
Okay, let's unpack that. A deposit token isn't like a stable coin, which is a new thing trying to be a dollar.
Exactly. A deposit token is just a tokenized representation of an actual dollar deposit already sitting at the bank.
So it's a bank liability. Falls under existing banking rules.
Right. And that fractional reserve aspect, that's just normal banking. It gives it the scalability and, crucially, the regulatory clarity a giant like JPM needs if they're going to handle, institutional level volume.
But, okay, doesn't that feel a bit tame?
Yeah.
For the crypto space, you could argue that by sticking so close to the existing banking system with deposit tokens, they're kind of missing the whole point of crypto, the decentralized innovation. What do you think?
That's a really fair challenge. And it gets to the heart of attention here. Look, for an institution moving trillions daily, like JPMorgan, the top priorities are always going to be efficiency, managing risk, and satisfying regulators.
Not necessarily disruption for its own sake.
Exactly. They're not trying to build a brand new financial system from the ground up. They're looking to upgrade the plumbing of the current one using blockchain tech. For big institutions, maybe this regulated, familiar, scalable approach is actually the most realistic path for digital assets to get widely adopted, even if it feels less revolutionary to crypto natives.
So, wrapping this up, what's the big takeaway for you listening?
Well, this deep dive really shows that huge financial players like JPMorgan aren't just sitting back anymore. They're actively involved trying to shape how digital assets integrate. And their choice leaning towards deposit tokens over stablecoins, it tells you a lot about how they see the regulatory landscape and the market's needs. They're choosing integration, not separation. Yeah, and maybe the final thought to leave you with is this. If a titan like JPMorgan thinks deposit tokens are the superior alternative for big money flows, how could that reshape the entire digital asset world? Could it change how you eventually interact with traditional finance when it becomes tokenized? What does it really mean for money itself as these lines keep blurring between the old financial world and the new digital one? Something to think about.